My name's Jas Bhogal. I'm a corporate partner at Harper James, and today's session will be about seed funding. So I wanted to cover today, obviously just to introduce you first of all to Harper James, and then talk about different types of investments available. Essentially, we'll be focusing on direct investment for shares in this session, but I will touch very briefly on other different types of investment structures as well. As Rowan mentioned, please do add questions throughout in the chat to Toby and Victoria, or we can pick up the questions at the end. There'll be some time, hopefully, to address any questions that you have. So a little bit about Harper James. We were established in 2014 by Toby Harper to provide accessible legal services to startup companies and scale-ups to support them throughout their growth journey from beginning, from concept to exit. The way we do this is we make ourselves an accessible service by offering a subscription service which clients subscribe to, allowing them to unlock discounted hourly rates in relation to the services we provide. We do this by the way we're set up. Essentially, we the majority of our lawyers work remotely from home, which allows us to manage our overheads, which we then pass on our cost savings to our clients. Most of our lawyers are partner level lawyers. We have all worked at the top 100 UK law firms or have worked in-house, so we have the level of service that you'd normally expect from any large commercial law firm. The only difference is we see ourselves as more affordable with regards to the prices that we charge. And we're a fully fledged commercial law firm, so it's not just corporate that we could support you with, it's through any other services associated with the commercial field itself. So with corporate, a lot of it's attached to IP, employment, commercial property, that sort of thing, and we'd support you throughout your journey of growth in all commercial areas. So just a little bit about me. I joined Harper James in 2014. I was the first person to join Toby when he set the firm up, and I have been with them up until now. And we actually ourselves have been on a growth journey throughout that time. So from the two of us, we are now around 70 employees with about 50 lawyers supporting thousands of clients with their legal needs on a daily basis. So if we launch into the topic itself, then as I said, today's talk will essentially be focused on investment opportunities themselves and how the investment process is structured. I wanted to focus mainly on direct equity investment today, even though there are a number of other investment structures available, and obviously over the more recent years there have been more degrees of flexibility with regards to how you structure the investment process itself. But the more traditional ones are the straight direct equity investment for shares and convertible loans. The direct equity investment itself can be structured in a number of ways, and I can talk about that as we go through the slides, but predominantly I'll just be focusing mainly on the direct equity investment for shares, just given the time that we've got. Before I launch into the actual investment process itself, I just wanted to touch very briefly on SEIS and EIS relief, and I will pick this up throughout the slides as we go through the talk. But SEIS and EIS is a useful tool for companies to have available to offer their investors. It's a great incentive for individual investors to claim tax relief in relation to their investment, and it was introduced by the UK government some time ago to incentivise investors to invest in companies. It allows them to claim tax relief on their investments that they make. So it's an allocation of the risk with regards to the investment, and it's a huge incentive for investors. So if a company is able to offer SEIS and or EIS relief, it's always useful to obtain the advance assurance from HMRC before the investment process starts, so they can use that as almost like a carrot to dangle in front of the investors as an additional incentive to secure the investment. There's some really useful information on the HMRC website with regards to guidance. It's not the most easiest to read, but it does provide you with some information with regards to eligibility criteria for the company to make sure it's eligible to grant the shares subject to the relief, and also for the individual investor, as both parties themselves need to be eligible for the tax relief to work. So with regards to the investment process, generally speaking, there's two key documents that you'll need. You'll need the subscription and shareholders agreement itself and the articles of association. In addition to that, I just wanted to touch on a couple of the other documents that you will need in relation to the investment process itself, because it's a whole process that takes place there's a whole sequence of events that has to take place in order for an investment to proceed from day one up to completion. And I just wanted to touch on some of the other documents that you will come across throughout the process. When you approach an investor, you will have that they will require a level of information about the company in order to determine whether or not they wish to proceed with the investment and whether it's appropriate for them. And they will want the company to disclose certain information about itself so they can make an informed decision. That information, a lot of it will be publicly available from Companies House or Googling or from your website itself. So, you know, you'll be comfortable disclosing that information. But subject to the investor, who the investor is and the level of due diligence that they're carrying out, they might require disclosure of more confidential information about the company. And before you proceed with the disclosure of that information, you want to be comfortable that that information will only be used to progress the investment itself and won't be used for any other purposes. And therefore, it's not unreasonable at that point in time to ask the investor or the potential investor to enter into a non-disclosure agreement or a confidentiality agreement. And that will give you the comfort that you need. And they'll expect that based on the level of due diligence that they're carrying out. Before you actually present to an investor, I always advise clients to spend some time on a share cap table, sorting out the finances effectively. You want to, before you present, you want to know what your share cap table looks like at the moment, so who your shareholders are, the percentage equity allocated to each shareholder at this point in time, and also what you're prepared to give away in this round. So and it will be based on what you can agree to be the pre-money valuation of the company. So you need to value your company, you need to have some rationale for the valuation of the company, and then work out how much money you want and what impact that has on dilution with regards to all of the other shareholders and your existing your existing shareholding as founders or shareholders in the company. With regards to valuation, and I know clients often ask us for our advice on valuation, and it's always difficult for us to advise on how you value a company, because essentially the value of a company is what you can persuade someone to pay you for. And the way that you would generally do that is you would provide a level of information to the investors or potential investors, you know, which would include a business plan, financial forecast, information about the business sector that you're in. You'll carry out market research on competitors and say, well, you know, we're at this stage that they were at and they were valued at this, and we've got all of these lucrative discussions going on with these potential customers and clients, and we believe that this is the forecast of our growth. And these are predictions, so you disclose that level of information subject to the NDA if it was confidential, and then you'd agree your valuation, and that would then link back to your share cap table, which would then determine the percentage that you give away. So they're all linked together. So that's the importance of the share cap table. And it's often overlooked because people often think, oh, it's as simple as saying, I'm valuing my company at £1 million. I want 100,000, so I'm giving 10% away. But you actually have to physically draw up the cap table, work out the percentages, and then see how it works on a post-completion rather than pre-completion basis, because percentages don't always match up. And then you just need to make sure that you're agreeing to give away the correct percentage. So it's ideal to start from the beginning and then follow it through to the end. So before you've even presented, you've got your final cap table in front of you based on what you're looking to raise. So if I move on to term sheets next. So the term sheet, it's not a legally binding agreement or document. It basically sets out the material terms of the investment that you will present to any potential investor. And it's always useful to start with that at the beginning. Once you've got your share cap table, you know what you're raising, you know what you're giving away. You want to decide and determine in your own mind, what rights am I prepared to give this investor when they give me their money? What am I prepared to give them? What level of control am I prepared to give them? So it's not just about giving them shares and percentage in the company. am I giving them any rights? What are the conditions to the investment? Do I need to do X, Y, and Z before they put their money in? Are there any milestones that I need to meet? Are there any contracts that I need to agree and sign up to before they invest? In addition to which, you'll want to consider what other rights you're going to give to the shareholders with regards to if it's a passive or active investor, what level of input you want from them, or what level of input they want to have involved in the company, and whether you're happy to give them that. And subject to the investor, you'll have to agree different types of information rights and reporting requirements. If you've got say a fund investor, they'll have a different level of reporting, internal reporting requirements themselves, and therefore there'll be a higher obligation on you to provide more formal reporting so they themselves can comply with their internal obligations. So the material terms will be set out in the term sheet, and as I said, it's not legally binding in itself, but there will be certain provisions that will be legally binding, only a couple of them, essentially exclusivity and costs. So your investors are going to be entering into discussions with you. They're possibly going to engage their legal counsel, their financial advisors to help them with the due diligence process in order to determine whether or not they wish to proceed with the investment. So they will want some level of commitment from you that you're not going to walk off with another investor who you've managed to agree a higher valuation with after they've incurred all of these costs, and therefore you often introduce some sort of exclusivity period to say, well, for the period of 6 weeks, I will only negotiate with you on these terms. And in order to give you that comfort, if I walk away during this period, or if negotiations break down, which I have caused, then I will pick up your reasonable costs, and you'll always agree some sort of level of cap on those costs. So you're not going to be out hundreds and thousands, you'll introduce like a £5,000 cap. So you know what your level of liability is if you do walk away. And then so the basis of the term sheet is not only just to focus on the material terms, it also allows you to flush out any red flags from day one. So if there is anything essential which an investor is looking for, they'll raise it on day one. They'll say, well, actually, in order for me to invest, my fund investment criteria, or I need the following to be satisfied before I can invest. And then it allows you to agree and negotiate those terms from the outset, rather than spending time and money on legal fees preparing the legal documents, which we'll have to amend. So it's useful spending that time now at the beginning to sort out the material terms. And as I said, although they're not materially binding themselves, legally binding themselves, these terms, lawyers often go back to this term sheet and say, well, this was in the term sheet and this is what we've based the legal documents on. If it wasn't agreed at the time, it should have been raised, and it's always difficult to move from there. So it's worth spending that time making sure that you get those rights set out from the beginning. So when you're approaching investors, you will want to have some level of comfort in relation to who these investors are. Ideally, you want to identify who they are, how you've met them. If you're presenting to a group of investors or angels, you'll know how, you'll meet them there. But if they've come to you from somewhere else, you'll want to know how they found out about you. You'll ideally want to identify who they are to make sure that they're not a competitor and they're investing in their own right, and they're not going to be releasing any information that they receive as a shareholder to a competitor. But you'll also want to make sure that they are who they say they are. So it's not unusual for you to say, can you provide me with a passport? So I need to ID who you are. In addition to which, you will want them to self-certify as a high net worth individual or sophisticated investor, because you don't want to be caught by the financial promotions under the financial regulations. This will mean that, because you don't want to be caught out by saying, well, you've induced somebody to invest in your company, you've presented them with this business plan, and they've put their life savings in and they've lost all their money. So they need to self-certify that they know what they're doing, they've taken their own advice, and this is something that they do on a regular basis. So that's due diligence from your point of view. You want to be comfortable with that. In addition to which, I often say to clients, you want to be comfortable with the source of funds. You want to be comfortable that it's, it's real money. It's not, it's not come from somewhere. So, obviously this is the very basic. If somebody comes up into the registered office and says, well, here's my investment money in a brown bag, you don't take it. And then it's just common sense, but you just want to be comfortable that it makes some sort of logic that this person has got, the 100,000 to invest in the company. It's come from legitimate sources. So moving on. So as I said, there's two key documents that will deal with the subscription itself. There will be the subscription and shareholders agreement, which I'll talk about now, but there'll be articles that we'll talk about in the next slide. So the subscription agreement itself is essentially broken down into two parts. The first part will deal with the subscription itself, which will include those material terms that we talked about when we were looking at the term sheet. So it will talk about who's putting the money in, how much they're getting, percentage equity wise, and their details with regards to the investment and the number of shares that they're getting, and or deal with the mechanics of completion, as in you put the money in, this is the bank account, we'll issue the shares, and any conditions to completion, effectively picking up those points in the term sheet. In addition to which, the first half will also manage the risk associated with the investment. I mentioned when you go and speak to an investor, you'll present them with a business plan. You might present them with management accounts or accounts of the company or other information about the company, which they are going to rely on in relation to their investment. So they need to have some level of comfort, or they will want to have some level of comfort that the information you have provided to them is correct and accurate, not just at the date you provided it to them, but at the date of the actual investment itself. And the way you do that is you introduce warranties into the subscription agreement itself. And warranties are contractual promises or statements about the company at a particular point in time, as in at completion, and they'll often cover the material points about the company, as in the share cap, the liabilities, the corporate structure, the any litigation, the asset ownership, employees, that sort of thing. So it'll be material points of the company which will be fundamental to the investment. And if those warranties prove to be incorrect, as in you knew they were wrong, but you didn't disclose or you didn't introduce any various limitations, they'll have a claim against you for breach of warranty. The warranties are often given not just by the company, so they couldn't just claim against the company, they could claim against the founders as well, because often investors will want the founders to be personally liable. So the founders focus their minds that I'm going to be personally on the hook. This could be my house that I have to sell to compensate you. So I am that focused on getting this right, and I'm that sure what I'm saying is correct. And obviously we would try and manage that risk for you with regards to a claim arising, and there's various ways that you can do that. You would introduce limitations within the contract itself, which, for example, the time period within which a claim can be brought might be 12 months. After 12 months, the liabilities, the risk of the claim will fall away. You'll introduce some commercial thresholds that any individual claim or all claims must meet in order for them to be some commercial rationale to bring a claim. Because you don't want someone bringing a claim for £10 because the legal costs will far outweigh that. So there's got to be some commercial logic. You may also want to introduce the option to remedy a breach. So we'd introduce all those limitations to manage the risk of the claim itself. In addition to which, you can consider disclosures. If you disclose against a statement and you've told the investor they are prohibited from bringing a claim for that breach, so the more information you can provide to them, the better off you are. I mean, you don't want to just disclose everything because they won't accept it. So it's got to be appropriate. Ideally, you want your warranty schedule to be correct. If it's not correct, you need to tell us why it's not, and then we will disclose against it. And it's worth spending that time, particularly because it's not just the company's liability, it's your personal liability. And if an investor is going to bring a claim, they're more likely to bring it against the founder than the company, because they're a shareholder in the company. So essentially their party suing themselves. And I know I've harped on a bit about warranties, but I just wanted to highlight how significant they are. But having said that, I've been working in corporate for over 20 years. I've never had anyone bring a claim for a breach of warranty. So they are very rare, but they do happen and the risk is real. So it's just something to be aware of. So as I said, the first half of the subscription agreement will deal with the investment itself. And then the second half will normally deal with the shareholder rights and the management of the company and the control of the company on a daily basis. And those include things like investment information rights, any appointment rights that you've agreed to grant to any shareholder who maybe, you might identify someone as lead investor. They might have a specific skill which is appropriate to your business sector, and they could offer advice or input that you think would be great at board level. And it might not necessarily be as a director, but you could look to offer them, say, an observer position where they can attend meetings in a non-voting capacity, but still put forward their ideas, which might be useful for you. So the day-to-day management will be run by the board and the company itself, the director. So as founders, you'd continue to operate the business as you normally do, and the decisions would be made at board level. The board decisions would. Often, however, investors as a group or if you've got a fund, they'll want a level of control over the very, very material decisions that the company makes. For example, appointing an administrator or a liquidator, entering into very onerous contracts or contracts over a certain value of, say 100,000 or whatever is appropriate for your particular company, or entering into any litigation, that sort of thing. And they'll want to have some control over those decisions, in that not only will you have to comply with the statutory provisions with regards to getting the necessary shareholder consents under the Companies Act, you'll also have a contractual obligation to get consent from the investors. And it's important to take time to see what these reserve matters are, negotiate on these, because you want the freedom and flexibility to make decisions and not get caught up in red tape by having to collect, go to investors on a regular basis to get these consents. Another thing that you'll often see in the subscription agreement itself is restrictions on the founders themselves. So when you present your business plan and you present to investors, the investors will buy your business because they'll like the idea. They might have a specific interest in the sector that you're in, but they'll also buy you. So they will want comfort that you're committed to the business and that you're not going to go off the day after completion and set up next door doing exactly the same thing, using the money or taking the clients and the employees and that. So they'll introduce restrictive covenants on the activities that you can do once you cease to be a founder or an employee of the company or shareholder, or you leave. So if I just move on to articles, I'm just conscious of time. So articles, they themselves are a contract as well, which all of the shareholders are bound by. The difference between the two essentially is articles is a publicly filed document at Companies House. Everybody can access that. So if there's anything in there that you think, actually, I don't want this to be public information, you can choose to put it in the shareholders agreement, which is your private contract. The articles would deal with the rights essentially that attach to the shares themselves, including voting, distribution, transfers, preemption, drag along, tag along. And I'll talk briefly about those, very briefly. So preemption allows the individual investors to retain, or the option to retain, their percentage equity in the in the company, in that any new shares that are offered for investment in any subsequent funding round are first offered to the existing investors, so they've got the option to maintain their percentage shareholding. Then you've got permitted transfers, which allows individuals to transfer shares to manage their own tax, internal tax liabilities. So you can transfer to partners, associated companies, family members, that sort of thing. And you've got drag along and tag along rights. The way these work is they relate to the transfer of shares. Drag along rights are in favour of the majority shareholders. So any exit which is approved by a majority, and you can introduce whatever threshold you want here, but it's normally over the 60% mark. So if the holders of over 60% of the shares, or whatever threshold is agreed, agree an exit, then they can force all of the other shareholders to exit on exactly the same terms. This gives the majority the comfort that they're not going to be held ransom by a lone shareholder who's either become unresponsive or uncooperative, and they'll prevent the sale of the company. So you can force them to come along. Now, the tag-along rights work in a similar way, but they work in favour of the minority. So if the majority are selling, often over the holders of over 50%, then they have to procure that an offer is made to the minority shareholders to exit on the same terms. Because as a minority shareholder, you don't want to be left behind. If the majority have secured a great deal, you want the option to be able to exit with them on the same terms. You want that opportunity. The difference is it's an option. There's no obligation under the tag-along rights for the existing shareholders to exit. And then one other point that I just wanted to raise was we talked about the commitment level of the founders to the company. Another way that the investors will seek to get the commitment and the comfort on the commitment of the founders to the company is by introducing what is called leaver provisions in the articles, which will effectively mean that the shares held by the founders will be subject to vesting, essentially being they want you to earn your shares again over a period of time. And the leaver provisions often lead to a lot of negotiation. They form like maybe hours and hours of discussions to be had between the founders and the investors about the level of risk that the founders are prepared to accept with regards to how the leaver provisions work. Essentially, it's basically saying that if a founder leaves the company, they either lose their shares or they can keep some of their shares on in certain circumstances. And in addition to that, you'll introduce good leaver, bad leaver provisions. So if you're defined as a bad leaver and you've done something fundamentally wrong, example, you've been fraudulent, that sort of thing, then you could essentially lose all your shares for nothing, or they're converted into deferred shares with no economic value. If you're a good leaver, however, then subject to the vesting schedule and the time that you leave, you can either potentially keep your vested shares because we say you've earned those, or you could sell them at market value, so you participate in the uplift at the time that you leave, or and the deferred, the non-unvested shares will either be subject to conversion to the non-economic deferred shares or subject to deemed transfer. So it's almost like a penalty, and it's an incentive to get the founders committed to the company during the period of time that the investors seek is appropriate with regards to the progression of the company. I think this is the final point. So in addition to those 2 key documents, there'll be a number of other documents that will be required in order to get us from beginning to completion. So the 2 key documents, you'll have your ancillary documents, will be board minutes, where the directors of the board approve the transaction and all associated matters with regards to the issue of the shares, etc. There'll be written resolutions required under the Companies Act, where the shareholders authorize the directors to issue the shares, disapply any preemption rights or restrictions that apply to the issue of the shares, and subject to the stage that the company's in, there might be additional investor consents if you've already got an existing investor who you've given a level of control to, which we talked about when we looked at the reserve matters. So once you've completed all of those and you've got your investment and it's landed, and there'll be a number of post-completion matters to complete as well. You'll have to actually issue the shares, which will mean you write up your register of members, you write up your register of allotments, you'll issue a share certificate to the investor, you'll deal with all of your filings at Companies House, you'll record that the company has adopted new articles. If they have, you'll file those new articles, you'll file all of your forms at Companies House, so your records are up to date. And then you will also, if the investor has claimed tax relief, you will have to notify HMRC, who will then issue you with a certificate to send to the investor so they can claim their tax relief. So as I said, essentially I've just focused mainly on direct equity investment because I've only got the limited time at the moment, and I could continue talking about direct equity investments for some time, I'm sure you can see that, but I've limited it to the very basic. There are various other ways of structuring an investment subject to where the company is in its life cycle, how quickly the company needs to receive the money, and who the investor is. And obviously, you know, we can cover those in another talk, or there'll be various other information online, but you know, you could look to structure it as a convertible loan or even as a direct equity investment. There's various ways that it can work, which will allow you to to determine the actual valuation of the company at a later time. If you're not in a position to agree the valuation now, but you need the money, you can always introduce trigger events, which would then allow you to set the pre-money valuation at a future point in time. So there's various ways that you can structure it, but you know, it's beyond the time limit that we've got today, unfortunately, to go into all of the various options for you. But hopefully that's given you some insight into how at least a direct equity investment works. And even with any other investment, some of the provisions that I've touched on today will be relevant with regards to the vesting, information rights, reporting requirements, appointment rights, those sort of things. They will still be relevant to any structure of the investment. So hopefully that's been useful, and I think we're going to possibly see if anybody's raised any questions. I think that some people have raised them with Toby, but if anybody wanted to turn on the video or turn the mics on, I'm happy for them to speak and answer the questions online with you.
Thanks so much, Jas. Gosh, so much information. You're so knowledgeable about it. It's fantastic. I'm sure it's been really helpful. I've been blown away by that. I think we've had a couple of questions come through. Please do, if you want to just turn on your video and mic, please do talk. If not, Toby is here and he's going to read through some of the questions that have come through as direct messages on the comments chat.
Thanks, Ren. So we have one question through. And it's about whether you should follow certain templates or format for the documents, and are there any templates that we could possibly share as well?
Yeah, I mean, templates it's always a starting point for any investment, but no two investments will be the same. So there will always be bespoke provisions that you need to introduce into the document itself. So if you are using a template, you need to be very, very careful. You know, you could top and tail it, use the boilerplates at the beginning and the end, but the actual, say, for example, the conditions relating to the investment itself might be specific, or we discussed lever provisions. They will be specific to you, and you will want to take that time, take that legal advice to make sure that those provisions are correct for you and appropriate for your company, because they won't be the same for any two company. You know, I've been doing investment documents for years, and I work with companies on a daily basis doing their investment documents. I have never ever used the same document twice, ever. They've always been different, because every company will be a different stage, every company will have different needs, every investor will want different rights, and you just need to be careful how you structure it. I think we do, Toby, have some documents potentially that we could refer you to, but as I said, just be very careful if you're going to use them. It's worth taking the time and the legal advice to make sure you get those right.
Thanks, Jas. We have a second question as well. Would it be possible to explain what convertible loan notes are?
Of course, yeah. So convertible loan notes, effectively they're a loan. Now, the way, obviously, I'm sure everyone knows how a loan works. There's a lender who lends money to a borrower. They'll be subject to the terms of a loan agreement. There'll be interest payable on the loan. There'll be a repayment schedule introduced in respect of the loan. But the difference between convertible loan notes and a loan is, generally when you're entering into a convertible loan, is for the purposes of the loan to convert into shares. So it's not essentially on the basis that the loan is going to be repaid. It will convert into shares at a particular point in time on a trigger event, and the convertible loan itself will dictate those events, and it will also dictate the conversion price at which the loan will convert in respect of each event. So each trigger event will be subject to a different conversion price. So it's important to take time to make sure that you go through each of those and identify essentially what level of control you've got to dictate what the convertible price is in respect of each trigger event. So when we talk about convertible loan agreements, they're similar to convertible loan notes. So a convertible loan note is an instrument adopted by a company for a specific number of notes, which the company will issue to the lenders, who will then get a certificate, which will be like a loan note certificate, to say, I'm a note holder, I've invested £100,000 in the company under the terms of this loan note instrument. And the loan note instrument will essentially contain the same provisions that you'll have in the loan note agreement, as in the interest, the conversion, the redemption, any events of default, and any redemption premiums. Something just to be aware of with regards to convertible loans is there will often be a repayment mechanism in there. If, for example, you've entered into a convertible loan note and it's going to trigger conversion in 3 years' time, for example, and there's interest of 10%, there'll often also be a discount available on the price that's being paid as an incentive to the lender for coming in when they did. So if the trigger event, for example, is the next funding round, you'll often see that the conversion price on the next funding round will be a 10 or 20% discount to the price paid in that funding round. The point I was going to make is just be careful with regards to the repayment provisions, because often there'll be a redemption premium repayable if you decide to repay the loan, and the redemption premium can be very high. It can be close to 100% of the loan. So if in your mind you're thinking, actually there might be an opportunity for me to repay this and not suffer the consequence of the dilution if I issue the shares at that discount, and I might want to repay it, just consider what the redemption premium is and see if it actually works for you. So obviously try and agree the best terms before you enter into that, but it's just something to be aware of.
Oh, I think you're still on mute, Toby.
It's a great start there. We have another question through. And how do you determine whether an investor is right for your business?
Yeah, so as I said, you want to ideally identify who the investor is, and you want to consider what level of input they want in the company, and obviously what stage you are at. Ideally, if the investor has got no business expertise in the sector that you're in, you'll just want them to effectively be a passive investor, in that you'll want them to put their money in and then participate in an exit and possibly have some minimum voting rights if subject to the class of share that they're subscribed for. If, however, the investor is more active in the business sector that you are in, and you think, well, actually, they could be more like a lead investor, then obviously you might want to agree different rights for them. Whether or not the investor is right for you will be subject to the level of due diligence that you carry out. You want to be comfortable with who this person is, how they've come about you, how they've come to know about you, who's introduced you. If you'll randomly receive an email from someone in, say, for example, the Middle East saying, oh, I've seen your details online, I want to put in £2 million on this valuation, then, there's a red flag straight away, isn't there? You want to start thinking, well, how did they get my information? Who introduced me to them? How come they don't want to carry this level of due diligence out? You want to be comfortable with who your investors are, because as you continue to grow, you'll be getting more lead investors in, you'll be getting interest from big VCs or institutional investors. They themselves will carry out due diligence, not just on the company, not just on you as founders, but on your investors as well. They will want to be comfortable with who they're investing alongside with. So it's important for you to be comfortable with who these people are. And obviously the main one is, you want to make sure that they're not associated with a competitor, or they're not investing on behalf of a competitor to obtain information about the company or find out some information about the company. And that's where the NDA would come in place at the beginning. And also the shareholders agreement that you'll ask them to sign will include confidentiality provisions. So there'll be some level of contractual restriction on them, but obviously if you can carry out the level of due diligence from the outset to make sure you're comfortable, it puts you in a better position from there.
We have a final question as well. When is it generally the best time to start your seed funding raise?
Well, I think you've obviously got to have an idea which you can present to somebody. You'll want to have a business plan. You'll want to know, your investors will want to know what you need the money for, what the money will be used for. So you've got to have some forecast or some projection or some plan of where you want to get to and what you're going to use this money for. And, often with a startup, the founders themselves will invest a lot of their own money, as I'm sure everyone's aware, and, they'll get their friends and family to try and put some money in, and they'll take the company as far as they can with their own funds. And it will only be when they've got some viable business idea that they can sell that they'll be in a position to really seek funding, because you've got to be able to present that idea, you've got to be able to justify a valuation in order to get the funds. So you've got to have something there that you can sell.
Brilliant.
Thank you. That's all the questions we have, so I'll hand back to you, Rowan.
Thank you. Wow, thanks, Jas, and thanks for those questions. Really useful. It's good to actually see how it relates to the individual businesses. I thought that last one about when to start, like now, lunchtime today. But yeah, there's obviously things you need to have in place first. So I'm just going to wrap it up now. I want to say a huge thank you again, Jas. That was really informative. I hope we get to have another session with you in the future. The next 2 sessions we're planning with Harper James are on IP and employment law, so slightly different areas, and they'll be in the new year. If people do have more questions, Jas, following this, I mean, I'll send an email to everyone with the slides and some information, but can I send a contact detail that people could get in touch with someone directly?
Yeah, I think Toby's going to share some information after the
Great.
call, and he's going to send some, I think, the slideshow, and possibly I think there's a leaflet we've prepared as well with some information which hopefully you'll find useful about seed funding, and it'll go into a bit more detail actually on what we've discussed anyway.
Fabulous. Okay, well, thank you. We promised it was going to be over lunch, so we'll stop it there, because people will actually want to eat probably at this point. But thanks ever so much, and we hope to see everyone in the new year for the next lunchtime learning event. Thank you. Thanks, Jas.
Thank you all.
Bye. Bye.